This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Happiest stock on earth, profit rises, revenue misses, but the focus is on Disney's suddenly pressured cable network, ESPN.
Big mistake Warren Buffett thinks investing in bonds is, but if you own them, what should you do?
And second acts, a fast-growing group of entrepreneurs may be getting older, but they're not slowing down. Those stories and more tonight on Nightly Business Report for Tuesday, May 9th.
Good evening, everyone, and welcome. The NASDAQ closes at a record for the 30th time this year. But we begin tonight with Disney. A tale as old as time helped the entertainment powerhouse report a rise in earnings. The success of its latest adaptation of Beauty and the Beast, along with strength in its theme park business, helped Disney earn more money per share than expected. The Dow component reported earnings of $1.50 a share, 9 cents better than expectations. Revenue was just a tad light at $13 billion, but up nearly 3% from a year ago. That, along with disappointing operating income at its cable network business, which includes ESPN, sent shares initially lower late in the day. Julia Borston spoke with Disney's CEO about the quarter.
The one key takeaway for Disney, for all the investors who've been concerned about ESPN and the company's media networks division, Disney says it has it under control. CEO Bob Iger saying Disney's ESPN business is planning for the digital future to eventually have new digital revenue compensate for declines in its traditional TV business.
What we're seeing is some significant growth of ESPN subs and other Disney Channel subs, meaning Disney-owned channels, on those platforms. But so far, it's not enough to make up for some of the losses on the traditional ones. We believe ultimately we will see that, but these platforms are brand new.
Iger saying the strength of ESPN's brand and consumer demand for sports makes the service appealing to new platforms, such as Hulu's new TV bundle, saying these new platforms are just as valuable per subscriber as traditional TV is. As for reports swirling that Iger is considering running for president, Iger said he's focused on his job at Disney for the next few years. For Nightly Business Report, I'm Julia Borston in Burbank, California.
Robin Didrik joins us now to discuss what's next for Disney. Robin, welcome. She's a media analyst at Edward Jones. Robin, what do you think of what Mr. Iger just said there? Let's talk about ESPN. Basically, what I heard him say is that it is a business, a channel that is in transition, but that eventually they expect the revenue to even out.
Yeah, we would agree with that. When we think about ESPN now, certainly is and has been for the last couple of years the biggest challenge for Disney and across the whole media space. You know, what's happening in cable and how consumers are finding their favorite programs, how they're consuming more on mobile devices. That's certainly changing the whole landscape for all of these companies. So that's the challenge near term. We think it's potentially creating an opportunity longer term for Disney because we do think they have some of the best content out there, whether it's ESPN with sports or Disney Channel with family. And we think that's really what's going to drive their ability to transition to what we think is going to be a new environment for media going forward.
Give me your thoughts, Robin, if you would, on how the Beauty and the Beast remake did and Rogue One, and whether or not it met the expectations that you had for that side of the business.
Sure. Well, you know, the studio business has been so phenomenally strong for the last couple of years. And that's really been, you know, a worry, I think, for investors. How are they going to continue to meet those expectations, which are so high? And they've continued to rise to the challenge, and it's been pretty impressive. And Beauty and the Beast is the latest example of that, coming in at over $1 billion in box office, and now just being released around the world for further growth in that title alone. But as we look out here for 2017, you know, there's still a very robust franchise slate coming ahead of us. So we're looking for these very seasoned films, whether it's Guardians of the Galaxy, the second installment, or Pirates of the Caribbean, the Cars film number 3 from Pixar. A very strong slate to look forward to, and 2018 could be even more robust. So we continue to think the studios is definitely a bright spot here at Disney.
Very quickly, it's $111 a share right now. Very quickly, what's your rating on it?
we have a buy rating on the stock, and we think the stock is undervalued here for the long term. We look at this company to grow by 10%. I think that's going to drive the valuation here for years to come.
Robin Diedrich with Edward Jones. Thanks.
All right, thank you.
On Wall Street, the NASDAQ notched yet another all-time high, but the enthusiasm did not filter over into the other major indexes, which fell after the North Korean ambassador to the UK said his country will proceed with its 6th nuclear test. Here are the final numbers for you. The Dow Jones Industrial Average lost 36 points to 20,975. The NASDAQ added nearly 18, and the S&P 500 fell 2.
There are a near-record number of job openings in the United States, 5.7 million of them to be exact. That's the good news, and it's that employers are hiring and workers are feeling more confident about leaving their job for another one. The bad news is that not all companies are able to find the skilled workers they need.
A Federal Reserve official today said that she supports winding down the central bank's bond holdings. Kansas City Fed President Esther George wants the balance sheet to shrink this year and thinks reductions should be put on autopilot. As we've been reporting, investors will be watching for information on how and when the Federal Reserve unwinds its bond holdings, because the effect could be similar to an interest rate hike.
Winding down the Fed's bond portfolio could also eliminate a major source of demand for long-term Treasury and other securities. An asset class Warren Buffett says is a terrible investment choice over stocks. Here's what he told Becky Quick about bonds in an interview we aired for you yesterday.
Anybody that prefers bonds today to stocks is making a big mistake. I've been saying that year after year after year.
Dan Heckman, senior fixed income strategist at U.S. Bank Wealth Management, is here to discuss what you should do. A lot of people, idolize Warren Buffett, Dan. They think he knows a great deal, and certainly he does. And they might well think, well, gosh, maybe I should sell all my bonds. Should they?
No, we don't believe they should. Obviously, we have tremendous respect for Mr. Buffett. He's the greatest investor in equities of all time. But we don't think it's an all or none type of answer for a lot of individual investors. There's not a whole lot of Warren Buffetts running around there. Some people can't simply stomach the volatility that stocks bring. And we think non-correlated assets to equities, like bonds, are appropriate in this environment. Even Warren Buffett, Tyler, has mentioned the extreme valuation in equity prices. And I believe even within his Berkshire Hathaway operation, he's built up a huge cash hoard.
So if you need a decent return, not stellar, but a decent return, and you want to stay within the bond universe, what would you recommend?
Well, we think a number of areas are attractive. If you are concerned about the Fed raising rates, which we do think will happen this year, at least once, probably twice, then floating rate securities, whether they be government or corporate oriented, are very attractive. Many of them are priced against LIBOR, so they will move if rates do move up in the short end of the yield curve. We also think if you're concerned about inflation, Treasury inflation protected securities are appropriate. And then even though in spite of tax reform, we think if you're a high income tax bracketed investor, we think municipal bonds are relatively attractive here as well.
I'll believe tax reform when I see it, Dan, personally. That's my opinion. But be that as it may, let's talk about those floating rate notes or bonds, which a lot of people recommend as a way to hedge against rising interest rates. Where do you find them? Can you get them in mutual funds? Can you get them in ETFs?
You can get them in both of those varieties. You can also get them as individual corporate bonds. For example, many large corporations, a lot of banks, for example, actually issue floating rate debt. So whether they're exchange traded funds or bond funds, there's a variety of floating rates. Some are bank loans, some are corporate bond, investment grade, non-investment grade. So we think there's a lot of variety and options for investors in that area.
All right, Dan, thank you very much for your insight tonight. We appreciate it. Dan Heckman with U.S. Bank Wealth Management.
Thank you.
Still ahead, another video, another black eye for the airlines. But the stocks keep on rising. So why the disconnect? take a look at this. This is not what you want to see at the airport. Fights broke out at a Florida airport last night following the cancellation of multiple Spirit Airlines flights. Videos posted online show deputies trying to break up the skirmishes. Spirit said it was, quote, shocked and saddened to see the videos and blamed unlawful labor practices by some Spirit pilots. The union denies that allegation. There are reports that 300 Spirit flights have been canceled in the past week.
Meantime, American Airlines reported record traffic last month. It also raised its second quarter forecast for a key metric, total revenue per available seat mile. Lower fuel prices is one of the driving forces behind the upbeat outlook, and that lifted shares of American and its rivals across the sector. Major gains there. And despite all of the negative publicity surrounding the airlines, the sector's ETF is up 8% over the past month, easily outperforming the broader market.
But an interesting thing is happening in the airline sector. The stocks are rising. On-time performance, as we mentioned, is improving. But at the same time, frustration is rising as those videos emerge of passengers being dragged off of planes and airline CEOs being dragged up in front of Congress. Phil LeBeau is in Denver tonight with more on the state of the airlines. Good to see you as always, Phil. Can you explain the disconnect?
Yes, the bottom line has not changed for the airlines. The planes are still full. The profits are rolling in. You've got lower jet fuel prices. All of those mean that we will probably have pretty strong numbers posted from the airlines for the second quarter and probably for the remainder of the year as well. So those high-profile incidents and the threats of Congress to have more regulations for the airlines getting a lot of attention, but so far is not hitting the bottom line. And if you're an investor, you're looking at this saying, great, keep the profits rolling.
The bottom line is one thing, satisfaction and frustration are another. We've seen executives being brought up to Capitol Hill. What is the likelihood that changes will be made within the industry, either from the inside out or from the outside in?
Well, let's take two parts of that. From the inside, the airlines are trying to redouble their efforts to make sure that they are emphasizing customer service with their flight crews, gate agents, everybody in every airline. From the outside, as much as you will hear talk in Washington about let's have more rules for the airlines, that's unlikely. You're looking at a Republican administration and a Republican-controlled Congress. They're not likely to be pushing for more regulation of any business. So I think that despite all of the bluster that we heard on Capitol Hill about get your act together or else we will, we're not going to see more regulation for the airlines.
What can we expect as we get closer to summer? I mean, this is only the spring travel season, and we've already had two high-profile incidents. What about summer?
Yeah, I think we'll have more. And I hope we don't have more, but look, all it takes is for one person to snap when they're on a packed plane or they can't get their bag in the overhead compartment. Everybody takes out their cell phone. Let me tell you, Sue, I've been on flights where I see somebody get a little mouthy with the flight attendant. Immediately, everybody takes out their cell phone. So I would not be surprised if you see more of that this summer. And all it takes is one person and one incident. And with the way things are spreading on social media and the fact that the airlines are in the target right now, I would not be surprised if we see more of these incidents.
Which means you're going to be very busy, Phil. Thank you so much.
Yes.
Phil LeBeau in Denver.
You bet.
And we want to hear your travel story. You can go to Nightly Business Report's Facebook page and give us your opinion on the state of travel in the U.S.
I'm going to take my seat and be quiet.
And be quiet, yes.
Yesterday
indeed.
we told you Apple was close, and today the stock did it. Apple closed at a record high, and the company is now worth more than $800 billion. The first publicly traded company ever to hit that mark.
There were some reports last week that Apple was having a bit of trouble with a key feature in its next iPhone, the fingerprint reader. But there may be other problems with those sensors. New research found that the way smartphones read fingerprints could make them vulnerable to hackers. Andrea Day has our story.
A fake hand with these master prints on it, then I can unlock, say, 25, 30, 40% of phones.
So how unique are your fingerprints? A team from NYU's Tandon School of Engineering developed these digital master prints that mimic random fingerprints and could potentially hack into your device.
First, I didn't believe it.
They didn't test it using real phones, only computer simulations, but say it still raises questions.
in order to unlock your phone, I don't need your fingerprint. I just need a master print. And I just have to do it once. Then I'm in business. Just bring me phones and I keep unlocking them.
So how does it work? The entire fingerprint would be tough to match. But he says most devices only use small, partial prints, making the sensors much easier to fool.
So when you take a small part of it, then that uniqueness tends to go down.
And since he says most smartphones store multiple prints and give you a few tries to unlock, that could open the door for hackers.
It's as if I don't have to get in through one window, but there are 30 windows. Any one of them is left open, I'm in. So to a security person, that's a problem.
But how this could work on a real device is still unclear.
You may have to create a synthetic sort of fingerprint, say a glove or a hand, synthetic hand, which has these master prints on them.
Apple posted the following online. Every fingerprint is unique, so it's rare that even a small section of two separate fingerprints are alike enough to register as a match. The probability of this happening is 1 in 50,000 for one enrolled finger, is much better than the odds of guessing a typical 4-digit passcode. In its latest Android software, Google requires a less than 0.02% failure rate for its fingerprint readers. And Professor Memon says he still uses a fingerprint to unlock his device and has no plans to change that, but says you may want to reconsider using a print for things like banking and other big financial transactions. For Nightly Business Report, I'm Andrea Day.
Valeant posts its first profit in a year and a half, and that's where we begin tonight's market focus. The drug maker missed revenue expectations, but investors didn't seem to care. They were focused on the company's stronger than expected earnings, which were helped by a tax benefit. Valeant also said it was raising its profit guidance for 2017, and look at those shares, up 24% to $12.05. Sanofi wants to put a cap on drug price hikes. The French pharmaceutical company said under its new policy, it plans to keep any increases this year under the rate of healthcare inflation, which is expected to hit about 5.5%, much higher than broad inflation. Sanofi shares rose almost 1% to $49.11. And fewer stores in operation helped Office Depot keep costs in check, resulting in earnings that rose and topped estimates. The office supply chain did say it experienced lower in-store traffic, and that hurt overall revenue and same-store sales. Still, shares up almost 3% to $5.26.
Discovery Communications said higher distribution fees and strengthen its international networks helped the media company grow its revenue. But the results missed analyst estimates. Profit also came in lower than expected, with the company citing its investments in solar power. Shares were off about 2% to $26.66. SeaWorld reported lower attendance in the latest quarter, blaming a shift in Easter and spring break schedules. The amusement park operator also said the drop in visitors caused overall sales to fall, but the company did post a narrower loss. SeaWorld shares rose 3% to $18.11. And also after the bell, Yelp posted a loss that was better than what Wall Street was expecting, but the company disappointed with its revenue guidance. The online review site missed sales expectations and said weakness would likely continue throughout the year. Shares initially plunged after hours following the news. They also ended the regular session down 2% to $34.70.
The CEO of UPS says there are growth opportunities abroad, in particular in the Middle East. And today, the company said it will take on a big project in Dubai, handling all of the logistics for the World Expo 2020.
It's going to give us name value in places in Dubai, the UAE, the Middle East, and really all throughout the world. And we really see this as a catalyst for growth, because when businesses from all these countries that come by, when they see our capabilities here, they're going to realize that we can also take care of their logistics needs.
180 countries are expected to participate in the expo, which will attract millions of visitors.
And UPS isn't the only package delivery company inking some partnerships. FedEx today announced a big bet on the popularity of golf. The company is extending its sponsorship of the PGA Tour for another 10 years. And it comes at a time when the sport has hit a bit of a rough patch. Dominic Chu reports from Ponte Vedra Beach, Florida.
One of America's biggest companies is making a big bet on the popularity of golf. Shipping and transportation giant FedEx just announced a deal to continue sponsoring the PGA Tour's season-long FedEx Cup playoffs for another 10 years. Financial terms were not disclosed. However, FedEx thinks any money is money well spent.
We have the benefit of 10 years of data that suggests this is a great deal. It's a great deal for our employees, it's a great deal for our shareholders, and it's a great deal for our customers. It aligns very much with our social responsibility platform, and we love what this platform brings for us in our alignment with the PGA Tour.
The sponsorship deal is the biggest ever for the PGA Tour, and it comes at a time when the future of golf is in question. Last year saw the bankruptcy of retailer Golfsmith and the move by athletic apparel giant Nike to exit the golf equipment industry. But this season has gotten off to a roaring start, and a host of events have produced some of the most dramatic storylines the game has seen in years.
It's such an exciting time. Never in our history have you seen the average age of a winner be as young as it is. We've got 88 players from 23 countries week in and week out. We've got between 10 and 15 players that have a shot to win midday on Sunday, and you've got new personalities emerging. I think that makes for some great storytelling, and there are a lot more players to come.
Competition's getting fiercer on tour, and a slew of young players are bringing excitement to the game. It used to all be about Tiger Woods. Today, the top golfers in the world are busy focusing on their own shot at greatness.
The competition on the PGA Tour and throughout the world is so deep and it's so strong that, you know, it drives me to continue to work hard, to continue to try to stay at that #1 spot. But it's very tough to do that because there's so many good players out here on the PGA Tour.
According to golf industry research firm Golf Datatech, 2016 marked the first time we saw growth in the number of rounds played by Americans for back-to-back years since before the financial crisis. And perhaps a big sponsorship between a big company like FedEx and the PGA Tour could go a long way towards fueling more popularity. For Nightly Business Report, I'm Dominic Chu, Ponte Vedra Beach, Florida.
Coming up, Encore Careers.
I'm Kate Rogers in Philadelphia, and tonight on Nightly Business Report, we're going to tell you why more baby boomers are opting out of retirement for a second act in business.
An update now on a health insurance story we told you about last month. Blue Cross Blue Shield will offer plans again in Knoxville next year. The company said it made the decision to re-enter the market, even though it's still not convinced the markets are stable. It will also likely need to offer high rates. Last month, we reported that Humana was the only exchange insurer in eastern Tennessee and that it was dropping out of the exchanges in 2018.
The mood of small business owners edged a little bit lower in April, third straight month of declines. According to a survey by the National Federation of Independent Business, owners were discouraged with Washington inaction on taxes, health care, and other issues. Despite the decline, though, optimism overall remains at historically elevated levels.
Well, retirement isn't what it used to be. A growing number of baby boomers are choosing entrepreneurship over leisure time, whether they need to or they want to. Kate Rogers is in Philadelphia tonight.
Brian Kravitz has seen his career come full circle. He began fixing typewriters in the 1970s and continued until computers came on the scene. But much to his delight and surprise, typewriters are back in vogue, and Kravitz is in business for himself at age 67.
I just feel really good. I get up every day. I don't want to sit around. I'm not going to. What can I do? Go to the golf course? No, not me. I want to do things.
He launched his business, Philly Typewriter, in 2015, fixing and selling machines that date back to the 1920s. Kravitz worked for years in marketing and direct mail and said his experience in the workforce has helped him with his latest venture.
I'm much more aware because I've had so many more experiences in being in business and doing things with people.
While millennial entrepreneurs like Facebook's Mark Zuckerberg may be grabbing headlines, 2015 data from the Kauffman Foundation found that baby boomers were nearly twice as likely as millennials to plan to launch their own businesses. Experts say the rise in boomer entrepreneurship is part of byproduct of the financial crisis that decimated retirement savings of many, and part the desire to remain active.
Most older people approaching the traditional retirement age are actually looking to stay active beyond 65. They miss the social aspect of work. They miss the purpose of work. And work is an important emotional contribution to people's sense of identity. And I don't think that disappears just because you hit a particular chronological age.
63-year-old Daryl Jennings launched his business, American Music Furniture Company, in 2013, and today has 7 employees and 2 co-owners, making humidifying cabinets for guitars. While he's seen success selling cabinets to musicians like Jason Isbell and Clay Cook from the Zac Brown Band, there are challenges in being an older entrepreneur.
The biggest challenge is the fact that you're not going to make money for quite a while. If you start a business, it always takes more money than you think it will. It takes more time than you think it will.
But he has only one regret.
I wish I'd done it sooner.
For Nightly Business Report, I'm Kate Rogers, Philadelphia.
And to read more about baby boomer entrepreneurs, head to our website, nbr.com.
Remember using typewriters?
Yes.
The sound
vividly.
of the office
the
was
sound
very
it
different.
was always there. Kind of miss it.
Yeah.
That does it for us on Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us.
And I'm Tyler Matheson. Thanks from me as well. Have a great evening, everybody. We'll hope to see you back here tomorrow.